There's actually a whole new regime coming in that taxes things additionally, in addition to those rate changes, that we haven't even seen before, that's connected with the Medicare legislation.
Yeah, that's correct. I mean, it's funny because the Medicare legislation that was put into effect a couple of years ago actually is scheduled to kick in January 2013 as well. And that puts into effect a whole other layer of tax. For example, there's a 3.8% additional tax on what's called unearned income. And in addition to that, there's an additional payroll tax of 0.9% on salary and self-employment income that kicks in as well.
So let's just focus on that for a second. So this additional 0.9% is an add-on to the existing Medicare FICA contribution that's currently paid by employees and self-employed individuals.
That's right.
So the self-employment tax Medicare portion is currently 2.9%. So when you add on this 0.9%, it's going to get up to 3.8% in total.
Yeah, that's correct.
And does that apply from first dollar, or is there a threshold for that?
It only applies if you're single and you have earned income above $200,000. It kicks in there. And if you're married, it kicks in on a combined basis for a married couple for your combined earned income above $250,000.
So it would be 2.9% on the first 250s, and then everything above that would be 3.8%.
Correct.
Now that's on earned income, which is basically what we think of as wages or income that would otherwise be subject to the self-employment tax by self-employed people.
Correct.
Now let's come back to the unearned part, because that really represents an additional 3.8% tax over and above what's already being paid.
Oh yeah, that's huge, and that's on a lot of different things.
So let's try to flesh that out a little bit. For these purposes, what's unearned income?
Unearned income is considered interest, dividends, capital gains, income earned on trade or business interests where you're not actively participating, royalties, annuities, well, a lot of different things.
And passive income, which we don't typically think of as unearned income. So if I'm an investor in an activity in which I don't materially participate, all that income, which is going to be subject to this new 3.8% tax.
Yeah, that's correct, and it includes rental real estate.
So that's huge.
Yeah,
3.8% on rental real estate over and above the 39%. You could be looking at an effective tax rate of 44, almost 44%.
Yeah.
What does this tax not apply to?
The tax doesn't apply to items like Social Security, pension and IRA distributions, things of that nature.
And active trade or business income. So if you have an active trade or business in which you materially participate, you're not going to be paying this tax. You're probably paying the other tax, the self-employment tax.
Correct.
So these are taxes that apply to individuals, correct?
Yes. And
the Medicare tax as well has an AGI threshold, I think, of $250,000. So if you're not over that 250 of AGI, you're not going to be paying this tax, and you're really only going to pay it to the extent you're over the 250.
Yeah, the way mechanically that it works is that if you're married and your adjusted gross income is above $250,000, you would pay this extra 3.8% tax on the lesser of your unearned income, as we talked about it, or the amount that you're over the $250,000.
And how do deductions play into this thing? Let's say I have a lot of investment interest expense or a lot of investment expenses. Do I pay it on the net after those things?
That's a real trap that needs to be understood in terms of this tax. There are relatively few deductions that go against that. No itemized deduction.
So it's pretty much a gross income tax. If my investment income, my unearned income, my passive income is above this 250, I'm paying that tax even if my net income is zero because of investment interest expense.
If you had a scenario where you wiped out a lot of your income through either charitable deductions or a lot of interest expense, you'd still have to pay that 3.8% tax on the adjusted gross income.
It's a pretty significant move.
Oh, it sure is.